Hey there, folks! Welcome back to another episode where we break down the complexities of the financial world. Tonight, we're diving into the wild world of international finance, a realm where numbers and policies shape the future of nations. Don't worry, we'll try to keep it as exciting as, well, watching paint dry, but trust me, it's more thrilling than it sounds. Specifically, we're talking about China and its massive stockpile of US Treasury bonds, a topic that's both crucial and intriguing. You see, China owns a whole bunch of these bonds, essentially IOUs from the US government. It's like a financial handshake between two of the world's largest economies. Think of it like your buddy owing you money after a wild night out, except it's trillions of dollars instead of a 20. The stakes are astronomically higher. This situation creates a fascinating dynamic, a delicate balance of power and trust. On the one hand, China benefits from investing in a stable economy like the US, gaining interest and a safe place to park its money. On the other hand, if China decided to sell off a big chunk of those bonds, it could cause some serious waves in the global economy, potentially leading to financial chaos. Imagine your buddy suddenly demanding all his money back. Your bank account might start sweating a little. Now, scale that up to a global level. So, why is this important? Why should we care about these financial maneuvers? Well, the relationship between China and the US is kinda like a giant game of Jenga, with the global economy hanging in the balance. Each move is critical. Any sudden moves could bring the whole thing crashing down, leading to a financial crisis that could affect everyone. Stay tuned as we unpack this financial thriller. We'll explore the intricacies, the risks, and the potential outcomes of this delicate balance. Alright, let's talk about the US dollar. It's kind of like that popular kid in high school. Everyone wants to be friends with it. People all over the world use and trade dollars, making it the dominant currency on the planet. But what happens when a country like China, holding a ton of US debt, decides to cash in? Well, imagine a bunch of people suddenly selling their shares in the popular kid. The demand for those shares goes down and so does their value. The same thing can happen to the dollar. If China dumps a bunch of US Treasury bonds on the market, it floods the market with dollars. This increased supply can cause the dollar's value to drop, like a bad investment on Shark Tank. A weaker dollar means that imports become more expensive, potentially leading to higher prices for everything from your morning coffee to that sweet new phone you've been eyeing. Inflation, anyone? Buckle up, folks, because things are about to get interesting. Now let's talk about the US government's credit card bill. Just like you and me, the government needs to borrow money to pay for things like infrastructure, defense, and those delightful political campaigns we all know and love. They do this by issuing, you guessed it, more Treasury bonds. But here's the catch. If China is selling off its US debt, it means there's less demand for those shiny new bonds the government is trying to peddle. And when demand goes down, the price goes up. In this case, the price is the interest rate the government has to pay on its loans. So, if China's selling spree spooks investors and makes US debt less attractive, the government might have to offer higher interest rates to entice buyers. That means more taxpayer money going towards interest payments instead of, important things like education or healthcare. Talk about a raw deal. Remember that Jenga tower we talked about earlier? Well, the US economy is like one of those crucial blocks at the bottom. If it starts to wobble, the whole structure is at risk. And guess what? China dumping US Treasury bonds could be the nudge that sets off a chain reaction. As the dollar weakens and US interest rates rise, investors around the world might get a bit jittery. They could start pulling money out of US markets and looking for safer havens, like a bunch of pigeons scattering at the first sign of danger. This capital flight could lead to a decline in US stock markets, impacting businesses and investors globally. Emerging markets, which often rely heavily on foreign investment, could be hit particularly hard. It's a classic case of when America sneezes, the rest of the world catches a cold. Section 5, Motives in the Shadows, Why China Might Sell. So why would China even consider playing this high-stakes game of financial chicken? It's a question that has puzzled many analysts and economists around the globe. Well, there are a few reasons why they might decide to cash in on Uncle Sam's debt. These reasons range from immediate financial needs to long-term strategic planning. First off, they might simply need the money. This isn't just about having cash on hand, it's about addressing pressing economic challenges. China's economy isn't exactly a well-oiled machine these days, and they might need to dip into their savings to stimulate growth or address domestic issues. The country faces a myriad of economic hurdles, from slowing growth rates to rising debt levels. It's like raiding the piggy bank when your car breaks down. Not ideal, but sometimes necessary. When unexpected expenses arise, even the most robust economies need to find quick solutions. Secondly, it could be a strategic move. In the world of international finance and politics, every action can have multiple layers of meaning. China might decide to use its treasury holdings as leverage in trade negotiations or geopolitical disputes. This isn't just about money, it's about power and influence on the global stage. Imagine holding your friend's prized comic book hostage until they agree to mow your lawn. It's a power play, plain and simple. In this case, the comic book is the vast amount of US debt that China holds. Finally, China might just be diversifying its portfolio. Diversification is a key principle in investment strategy, aimed at reducing risk. Holding all your eggs in one basket, even if it's the American basket, isn't exactly a sound investment strategy. Diversifying helps to mitigate potential losses. They might be looking to invest in other currencies or assets to spread the risk, ensuring that their financial future is more secure, like a squirrel burying nuts in multiple locations for a rainy day. By spreading their investments, they can better weather economic storms and uncertainties. Section 6. A house of cards? Could the dollar collapse? Okay, let's address the elephant in the room. Could China actually cause the US dollar to collapse like a house of cards in a stiff breeze? Well, it's complicated. The relationship between the US and China is intricate, involving trade, investments, and a web of financial dependencies that go beyond just holding debt. While China holds a significant chunk of US debt, they're not the only players in the game. The global financial system is interconnected, and many other nations have a stake in the stability of the US dollar. Other countries, institutions, and even individuals hold trillions of dollars in US Treasury bonds. These bonds are considered one of the safest investments, and a sudden sell-off would not only affect the US but also the global economy. It would take a coordinated and massive sell-off to truly tank the dollar. Such a scenario would require unprecedented global cooperation and a willingness to endure significant economic pain. Moreover, the US economy, while not without its flaws, is still the largest and most diversified in the world. Its economic activities span various sectors from technology to agriculture, providing a robust foundation. It's got a lot of fight left in it, and it's unlikely to go down without a fight. The resilience of American businesses and the entrepreneurial spirit play a crucial role in maintaining economic stability. Plus, the US government has tools at its disposal to try and stabilize the dollar if things get really hairy. These tools include monetary policies, fiscal measures, and international diplomacy. So, while a complete collapse is unlikely, it's not entirely out of the realm of possibility. Economic uncertainties and geopolitical tensions can create vulnerabilities. It's like that crazy uncle we all have. You never know what they're going to do next, but it's probably best to keep an eye on them. Vigilance and proactive measures are essential to navigate these uncertain waters. Section 7. Treading carefully. Navigating the financial abyss. So, where does this leave us? Well, navigating the complex relationship between China and the US, especially when it comes to finances, is like walking a tightrope over a pit of hungry crocodiles. One wrong step, and it's game over. Both countries have a vested interest in maintaining stability and avoiding a financial meltdown. China benefits from a strong US economy, and the US relies on China's continued investment in its debt. It's a classic case of mutually assured economic destruction. The key is communication and cooperation. Both sides need to tread carefully, avoiding any sudden moves that could spook markets and trigger a global panic. It's like a game of financial chess. Every move has to be calculated and carefully considered. Section 8. A final thought: interdependence and uncertainty. As we wrap up this wild ride through the world of international finance, one thing is clear: the global economy is a complex and interconnected web. Actions taken by one country, especially a major player like China, can have ripple effects that are felt around the world. The situation with China's US Treasury holdings is a perfect example of this interdependence. It's a delicate balance of power and risk, where both sides have a lot to gain and even more to lose. So the next time you hear about China selling US debt, remember this: it's not just about numbers on a balance sheet, it's about the future of the global economy and the delicate dance between two superpowers. And on that happy note, we'll leave you to ponder the mysteries of international finance. Until next time, folks.